Once you find your way out of Wall Street bets and aren't actively burning your money, you're probably looking for a better way to achieve your investing dreams. A better way to not only make money, but make a lot of money. It's very simple. It's even the strategy that some of the most famous investors like Warren Buffett recommend. You're just going to need time. I'm assuming that a decent amount of people watching this actively trade individual stocks or at least pick stocks to hold. I'm here to tell you that it's not optimal in any way. We don't have to listen to me. Listen to Peter Lynch, considered one of the greatest investors of all time. I've always found that if you find 10 stocks you really like and buy 3, you'll always pick the wrong 3, so just buy all 10. We'll circle back to this notion a little later since it's very powerful. I'll show you how to use that idea to achieve your investing dreams. Let's take stocks like Apple, Microsoft, and Nvidia. They're all huge companies that are insanely profitable. They're probably not going away anytime soon. So why the hell would anyone ever invest in anything other than the biggest, most profitable stocks? The answer is that everyone already knows that they're the best companies, and so the information and those expectations are already factored into the share price. The pricing in of information to a stock's price is known as efficiency. I also press on the fact that you like this video and subscribe to Omni Capital, so you're legally obligated to do it now. Sorry, it's out of my hands. Efficiency is why consistently making winning trades is so hard. Think about financial institutions on Wall Street. They probably have infinite analysis available to them, but yet 92% of fund managers don't beat the market. The market is a colloquial term referring to the collective performance of stocks, which is known as an index. Most people use the 500 biggest stocks in the US, which is known as the S&P 500, as a proxy for it. An index fund, like its name suggests, is a fund that tracks an index. No way. When you buy a fund that tracks the S&P 500, you're essentially splitting your money and buying a little of each of those 500 stocks. So why would you do this? Why is this the best way to turn your investing dreams into your reality? Why not try to research the stock market, try to find the best stocks to buy and potentially make more money? Why not gamble like Wall Street? Never mind. We've already learned that no matter how much analysis or research you do, it's nearly impossible to consistently pick winning stocks. Besides efficiency, another reason why this is because of the short-term noise in the market. In the short term, the stock market is literally completely random. I'm not just saying that it is just unpredictable. Mathematically, according to stochastic calculus, it is completely random in a phenomenon known as Brownian motion due to the chaotic interactions between buyers and sellers. However, over the long term, the market does have a clear direction. Let's go back to the S&P 500 or really any other index. Zooming out, you don't need a PhD to realize that stocks usually go up over the long term. Despite the market being pretty much random in the short term, it does drift upward over the long term. This is because of the universal truth of the world is the fact that economies and companies grow. If they didn't, they wouldn't be staying as functioning economies and companies for long. Although some do somehow slip by. I personally suck at this whole stock market thing. I'm sure you probably do too. I know there's at least another 60 million people that do as well. There's no way you can mess a trend like this up, right? So, the pattern and dream I've been talking about are index funds? Yes, but know that there's a right and a wrong way to invest in index funds. It's pretty hard for someone like you or I to mess up pressing the buy button on an index fund to outperform 92% of Wall Street. You're missing out on your full potential if you don't take into account some of the things we'll be discussing in the rest of the video. We'll put it all together by the end, so make sure you stick around. I personally think that M1 Finance is the best brokerage to use if you want to buy index funds for the long term, due to the many convenient features for this style of investing. You can get a free $75 or more as a referral bonus if you sign up for it and open an account using the link in the description. Firstly, the index I talked about earlier was the S&P, which is large stocks in the US. But other companies do exist besides large cap US stocks, and it's often wise to invest in them as well. The reason why smaller companies often do better than bigger ones is that they're not as well known, and so their true value is not yet realized. Of course, this makes individual small cap stocks much riskier, but on average they do outperform over the long term. Furthermore, you're really shooting yourself in the foot by only investing in US stocks. A lot of people, quite frustratingly, completely dismiss international stocks that they did pretty terribly compared to the insane bull run that US stocks has had over the past decade and a half. But if you zoom out even further, you'll see that in the 2000s, US stocks did horribly since there was 2 crashes in the same decade, while international stocks did pretty well. They all have their own periods of performance. This is why, looking towards the future, you should be invested in both. The last major factor you need to diversify across is being invested in both value and growth stocks. Growth stocks are companies that are considered to have the potential to outperform the overall market over time because of their future prospects. Meanwhile, value stocks are companies that are currently worth less according to the market below what they're really worth and thus will provide a superior return over time. Both are good long-term, and having both growth or value is needed. For instance, the S&P 500 already has both growth and value stocks in it. So, what is a good portfolio of index funds for the long term? This is what I personally like the most. But know that everyone could have their own investing philosophy. I mean, I just showed you mine. An equal split between US large cap growth, US large cap value, US small cap value, and international stocks of all kinds is pretty optimal. But then again, people do have different opinions as to what is actually considered optimal. The reason why we aren't including small cap growth is because it's consistently the worst performing sector of the market due to some fundamental issues. Just know that those two things are probably not a good combination. It's literally called the black hole of investing. The index fund they can use to capture these market segments are listed on screen. Pause if you want to read them. The one bolded is the one I personally think is the best, although you can't really go wrong with any of them. The goal here is to minimize the expense ratio. So now let's put it all together. With your knowledge of index funds, what should you actually do to turn your investing dreams into reality? Let's say hypothetically you have $100,000 ready to invest. Let's say you know it's hypothetical. Is it better for me to invest $100,000 into the index funds all at once, or should I buy a little at a time, such as buying $1,000 every week for the next 2 years or so? There are pros and cons for each. Because the market tends to go up more than it goes down, which is why index funds even work, statistically you'll be buying at the lowest price now most of the time at lump sum investing, meaning that you will make more money most of the time. However, in the event of a correction or even a crash, putting in a little at a time known as dollar cost averaging allows you to buy the dip and reach a lower cost basis on your shares, leading to better gains. It's also better psychologically, since you don't have everything on the line right away. I would personally go with the latter, but again, it is up to preference. You're going to also need to rebalance your portfolio every once in a while. For example, even though we start the allocations of the portfolio I talked about at 25% for each fund, as the funds go up and down different amounts, they will now not be worth 25% each in the future. Again, M1 Finance makes this really easy. This does not sound like a lot, but because you get compounding on your compounding, it adds up. If we start with $100,000, after 5 years you'd have $161,000, but after 25 years you would have $1.1 million. After 50 years you'd have $11.7 million off the initial $100,000 investment. And that's really the beauty of long-term index investing. Dump some money to them today, sit back, relax, wait a couple of years, and make almost guaranteed money. Time is money, so why not save time to get more money? Seems like a win-win for me. The tortoise will always win over the hare when it comes to investing. If you think it's a win-win as well, but might still be thinking of ways to optimize your use of index funds further, well, there's a simple strategy with them that turned 10,000 to $1 billion in the last 50 years while having the same risk as the S&P. This video explains everything you need to know about it here. Subscribe and I'll see you in the next one.